All right, guys, welcome back. We're going to talk about our credit report and credit score today and just dive into some of the details so we have a really good base understanding of what these are. So there are three main credit bureaus: Experian, Equifax, and TransUnion. They are the ones that collect all of our data around what loans we have, what payments we make, if we've defaulted on any loans. They keep track of anything in regards to our credit. And basically, this is what lenders use when they want to check your credit worthiness. They'll check your credit report and say, hey, what's happened? What is this person's history? And what is their current situation like? So they each have a credit report that you can get. There's a lot of services out there where you can pay for this, but there are a number of, the government's put in place a lot of laws to protect consumers. And so since having our credit report is extremely important, they've required that each bureau, well, they basically put three main guidelines in place for them. So number one, that the credit bureaus have to make sure the information they collect about you is accurate, okay? Number two, they have to provide you a free copy of your credit report once every 12 months. And number three, they have to give you a chance to fix any mistakes. Mistakes do happen. You might have paid off a loan, but on there it shows as it's not paid off and that you have an open credit that you owe and it's dragging your credit down. Different things like that. So if you discover mistakes, you can submit kind of claims or appeals to get mistakes removed and so on and so forth. But the government kind of put into place those three guidelines, okay? So they've created one centralized website where you can go and obtain your free credit report. It's called annualcreditreport.com. Below this video, I'm including an article on the government's website about this and different things about the bureaus. And so you understand what your rights are. But annualcreditreport.com, you can go and sign up and you can get access to that credit report from each of the bureaus every 12 months. Okay. So definitely do that. You want to make sure, if you've never looked at it, you want to take a look and say, hey, is this accurate or is this not accurate? It'll show different accounts that have been on there, if they've been closed or what the status is right now, if they're active. It'll show dings against your credit, like, hey, late payment here, or hey, this account was sent to collections or whatever. So you want to make sure that's accurate. If there's inaccuracies, you can go through the process of having those removed so it doesn't damage your credit further. If it looks good, then great, but you can keep track of it moving forward. This is also important from the standpoint of identity theft and protection, right? Is if somebody opens up credit in your, using your identity, your birth date, your name, your social security number, those are going to be linked to you and it could create havoc, right? So part of the purpose of identity theft or protection against identity theft is making sure that your credit isn't damaged severely. There have been numerous cases of that happening, and it's just not a good place to be. So you want to check it, and you want to check it with some regularity, like once a year, and just make sure everything looks good and is accurate, okay? So annualcreditreport.com. Now, besides that, if you want to check your score, your credit report and your credit score are different things. You have your FICO credit score, and this is essentially adds up all of the elements from your credit report and puts it into a score. Now, each of the bureaus, not everything gets reported to all of the bureaus, and so you might see they're not totally the same. They might have some discrepancies and not include all your accounts, so there might be a mix and match. I don't know exactly why that happens, but it just does. So each of the bureaus calculates a separate credit score. So you could go on and get your Experian credit score or Equifax or TransUnion. They could be a little bit different, but generally speaking, if most of the information is similar, then they're going to be pretty close, okay? But different institutions rely more heavily on different bureaus. So you might have one, if you apply for a credit card, they might check your Experian credit report and credit score. But if you apply for a credit card with another institution, they might use TransUnion. Same with auto loans and mortgages and stuff like that. So it's a good idea to just kind of keep a good eye on all of them, but know that there could be some discrepancies there. So here are the components of a credit score, and obviously why it matters. We talked about it before, credit worthiness. If you're going to qualify for a loan, it's a huge risk to lend out money for a bank. And so they need to have some reasonable assurance that you are going to pay them back. They need to know you're credit worthy. If you're not, they'll just deny you, not extend you credit. So here are there's 5 main components of a credit score and how they factor in their weighting. So payment history is top at 35%. Do you make your payments on time? Have you missed payments? How many payments have you missed? How late have they been? On and on and on. That's why doing auto pay with bills is so important so you don't get sent to collections. It's why keeping up with your payments and making sure that they're reasonable and that you can afford them and all that stuff, that's all extremely important here. So payment history. Next one is the amount owed. Payment history, by the way, accounts for 35% of the overall score. So over a third is just that one. So payment history obviously is important and the main factor. Like, will they pay me back? That's what the bank's thinking. Is this guy going to pay me back, or this girl? So amounts owed factors in 30% of the score. Okay, so just under 30, just under a third. This is credit utilization. And what credit utilization is your total amount of credit extended, revolving credit. So there's installment versus revolving. I have it listed there below. An installment is like you get an auto loan and you make these payments over this amount of time, and then the loan is paid off and it's over. Same with a mortgage. Mortgage works that way. Revolving credit is an open line. You can access it as much or as frequently as you want and pay it off and access more. So a credit card, right? You just spend and pay it and spend and pay it. That's a revolving credit. Installment is like set term, set payment, and once it's over, it's over. Okay. So they look at your revolving credit and they want to make sure that you're not using more than 30% of your total credit limit. Okay. So let's say you have a couple credit cards and your total limit is whatever, $20,000, but you regularly are using $5,000. You're going to be, that's how they determine your credit utilization. So we're going to jump really quick to the financial calculations worksheet. On this debt ratio tab, I've added a quick credit utilization ratio calculator. Again, anything in red is what you can change. The rest, don't touch it or you'll mess up the formulas. But essentially, you have your total credit available, total revolving credit utilized, okay? Like how much is actually on your credit cards. And then this is your ratio, okay? So it doesn't, if it's over 30%, that's not good. That's going to start damaging your score. The lower it is, the better. And so, yeah, I mean, if it's below 8%, I mean, that's ideal. So anyways, I've added that on there really quickly so you can kind of take a look. Credit mix. This is revolving versus installment. If you have a number of different credit products that you use and have a history with, that is more favorable. It shows the lender that you can manage these different types of loan products. So if you have some installment loans, like maybe you have an auto payment and a student loan, yeah, and then maybe for revolving credit, like you have a credit card or two. And so these are different, it's a good mix of credit and you're showing that you can manage those all together. That's going to look favorably. Okay, and that influences 10% of the overall score. Oh, I skipped credit history length. Credit history length is basically, they just take all your active credit lines and they average it out to find the average length, right? The average age. So if you don't have a long history of credit, then obviously you don't have as good of a track record and you're more risky. Okay, so if you have credit from 10 years ago, then that's obviously going to extend your average. If you've opened up 4 new accounts in the last year, your average is going to go down. It's going to be really short. So they're going to look at that and say, hey, how much credit they've been using and what's their history look like? That's 15%. And then the last one is new credit. So this is new accounts that you've opened. Typically, it's like within the last 12 months is what they look at. And then hard inquiries. So this might be, hey, maybe I want to refinance my loan. And you submit something to the mortgage lender and they go do a hard inquiry, right? Which means they check your credit score and your credit report, and it shows up as a line item on your credit report. Hey, this institution did a hard check on your credit. The more hard checks you have and new accounts you have, in a small amount of time or in the recent history, then it's going to influence your score. It's going to decrease it. So every time there's a hard inquiry, you'll probably see your score go down a few points or down a few points. Or if you've opened a bunch of new credit lines and had inquiries, or you could drop 10, 20, 30, 40 points, depending on what those look like. So they're going to look at that and say, oh, hey, they're really looking to get a lot of credit right now. We're going to hold off. Like we don't know why they're doing this, but it seems sketchy. So we're going to hold off. Okay. That accounts for 10%. Okay. So those are the main components. Now there are, like I said before, millions, it seems like, of websites that will do this. Credit Sesame, Credit Karma, Capital One, Chase. A lot of banks have their own, right? They'll link in your credit score and let you check it from one of the bureaus. So I think I have probably 2 of these. I think I use Credit Karma and Credit Sesame. They're really quick because they'll just pull in active data they're free on their basic level. They're free. They just show you a lot of ads and say, hey, you qualify for this credit card, or you qualify for that loan, and all that type of stuff. So you get a lot of ads served to you, but it's a good way to check and keep on top of your credit score. And then they usually have some suggestions about how you can improve things and that type of thing. So if you don't already use some, you can go check out some of those websites, and they can be kind of helpful to help you manage your credit in the best way. Now, the last thing I want to talk about before I end this conversation about credit scores and credit reports is, what do you do how do you improve your score, or how do you get a score? Like, what happens if you don't have a lot of credit or any credit? One thing you can do is you can start small. Okay. I think Experian has a product called Experian Boost, where it's a small membership, I believe. I'm not sure on the details. You can look it up, but essentially they'll allow you to not only count your debt payments towards your credit score and your credit report, but they'll also use regular payments of other types. So like internet or cell phone bills or utilities, you can hook those up and it'll show a payment history, and that'll contribute into your credit report and your credit score. So it's a fairly new product within the last couple of years that they've released, so you can start building credit that way. Another way is just to go out and open some credit, right? If you don't have any credit, you probably go apply for one of the most basic credit cards out there. There's a lot of sites about credit cards as well, but you could go apply for a very basic credit card, a normal cashback, no annual fee type credit card, and just start spending on it. If you have no credit, but you have decent income, then they'll probably approve you. It just might not be for very much. Maybe it's like $2,000 limit or something like that. So they won't let you spend more than $2,000 at a time or carry that much on the card. But if you do that, little by little, you might open up a few of those. Little by little, you could ask to increase your credit limit and say, hey, it's $2,000. I've shown a year of, on-time payments and I've been using it. Can you increase my credit limit? And they might, you can ask them and they might increase it to $5,000 or $7,000, right? Based on how you've been doing. So they're going to give you longer leash if you show that you're trustworthy. The other thing you can do, this is something that happened with my wife and I. So my wife didn't have any credit when we got married. And so when I got credit cards, I actually added her as an authorized user. So what happens is she's attached to my card and that credit account, but it's not dependent on her to qualify for it. I qualified under my own credit score and credit report, but I've added her. And so as we use this credit line and as it gets history, she actually started building a credit score and a credit history and report just by tagging along with mine. So I opened up a number of credit cards. I added her as the authorized user on all of them. And all of a sudden she started getting a credit score, and now her credit score is fantastic. She hasn't had any other loans really besides that. So we've been able to build up her credit score that way. So if you have a lot of credit cards, you can add authorized users. You can increase your limits, periodically ask for them to increase your limits. This also helps with the credit utilization. If you only have $20,000 of credit available and you're using 10, right, your credit utilization ratio is at 50%. But if all of a sudden you're able to increase from 20 to 50, among your different credit lines, then your ratio is at 20%, right? And so if you're regularly spending that, it's just as part of your day-to-day spending, then you can increase it and make sure your credit utilization stays really low by asking them to increase your limits. So anyways, there's a lot there to unpack. I may add more on this topic later, or I might subdivide it out into smaller videos, but that's pretty much all I wanted to cover there. So if you have any questions, certainly comment below and all of that, but check out annualcreditreport.com, and then also go sign up for one of these services that kind of keeps track of your credit score and just get an idea of what that is. There's different ranges, right? If you're over 700, typically it's really good. Over 800 is like excellent. 600 is average. Below that is bad, whatever. So you can check out what your score is and kind of make a plan to slowly increase that score over time using some of these strategies and improve your credit score, which will give you better interest rates, better terms on loans, and more access to credit when you need it. So we'll leave that topic there and we'll move on to the next. See you guys in the next video.
Progress starts with understanding.